Stocks are trading to the upside, at least for the Dow and the Nasdaq here shortly after the open. Now, quickly pairing some of those earlier moves to the downside that we did see on the heels of this morning's PPI print. Why? Well, we did see downward revisions to March's report that is offering investors some relief in terms of efforts and progress on inflation. So where does the market trade from here? We want to bring in Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Megan, it's great to see you here. So when we talk about the move that we're seeing here to the upside, at least to a little bit today, but really coming off the heels of what was a rally last week. What's your takeaway from that PPI print and exactly that movement that we could see ahead of tomorrow's CPI report?
I think what we're seeing right now in the market is it's getting very complacent. The PPI report today, the slight downward revision we had to March, I'm not focusing on that. What I'm focusing on is that 3.1% year over year when you exclude all of those volatile items. When you look at within that PPI report, it's services. And what has the Fed told us? That service inflation is very sticky. This isn't the only report that has warned us that inflation is not going in the right direction. You can look at the ISM Manufacturing Report. You can look at the ISM Services Report. All of these things are showing that inflation and prices are trending higher again. The market's completely complacent to this. The Federal Reserve is complacent to this, and we need to get some more hawkish rhetoric, or we're going to continue to see inflation pressures go higher.
So what does that mean in terms of portfolio repositioning right now?
So we've been holding on to cash, an overweight cash position, really this whole year. We did rebalance portfolios in the beginning of this year to get rid of some of those or take some profits on some of those parts of the market, your growth, your technology that rallied so much. Because we've always been in the camp that 6 rate hikes was absolutely ridiculous. That was never going to happen. We're now in the camp that, honestly, I think that they're going to have to remain on hold for the rest of this year. We're not quite ready to say a hike is in the cards yet, but we did have at least one rate cut at the end of this year, and I'm leaning towards removing that for our forecast.
So, Megan, I'm curious how you're looking at this resurgence that we've seen in the meme stock trade and exactly how that maybe potentially plays into the Fed's calculus here down the road, because we did hear from Kashkari suggesting in a blog post just last week that as we do see more and more interest in this meme trade, it is signaling maybe to some extent that financial conditions aren't really as tight as they should be up until this point. Do you see any truth to that?
Absolutely. This meme stock craze was crazy when it occurred back in 2021. It's just as crazy as it is now. And if you look at something like the U.S. Financial Conditions Index, this is showing that financial conditions are actually easy. This is a problem, and now we're seeing this speculation trades, the fear of missing out. This is all a bigger risk to the market. This is why we think we can still see at least a 10% correction. The timing of that, we're not exactly sure, because remember, markets can stay overbought. They can stay in this complacent area for longer than they should be. But when they do, that crash can be actually a little bit more than people anticipate.
And so compare what we've seen in some of the trading frenzy within this kind of meme stock iteration versus the one of 2021. I mean, that one saw much larger short interest positions really become eradicated, essentially, or have to be covered. But that's not the same case. Shorts have not, even been as vocal about the positions in comparison to what they were back in 2021.
Mm-hmm. Yes, and if you think that the people that are putting this stuff on Reddit or whatever social media recommendation tool that they're using, if you think they got smarter over the past couple of years, well, I'll tell you, hedge funds got much smarter. So I think that you're seeing that hedge funds learned from the mistakes back then, and they're not going to be positioned or as exposed if this were to reoccur like we're seeing lately.
Megan, do you expect to hear from Fed Chair Powell on this? He's speaking just about 20 minutes from now, but he has kind of bursted this meme stock bubble in the past when you take into account what he had said a couple of years ago. I'm curious how you look at that from a strategist perspective.
I'm not sure that he's going to really comment on the meme stocks. I think he's got some bigger issues. Honestly, the meme stocks is just noise to me. I think it should be noise to him. I think he needs to come out and address the information that we got today. Inflation is not going where he wants it to go. It's going the other way. And what's problematic, and he continues to downplay, is it's going in the wrong direction from a sticky perspective. Services is a problem. Housing is a problem. And these are things that he can't necessarily fix, but he does need to address it.
Where do retail traders typically go after a meme stock frenzy? Is there anything that we noticed outsized about where some of those traders flowed into after all the dust settled?
I think that they probably go back into some of the safe haven types of blue chip stocks, but that's if they have any money after this does settle out and they haven't lost a significant amount from being on the wrong side of this.
Megan Horneman, who is the Verdence Capital Advisors Chief Investment Officer. Megan, always a pleasure to get some of your insights and perspective. Thanks so much.
Thank you.